SCHD is widely seen as the king of dividend ETFs, but what many investors overlook is that SCHD alone does not fully complete a dividend portfolio. DGRO, the iShares Core Dividend Growth ETF, is often neglected, even though it has grown dividends every year since 2015, offers a solid yield, and has relatively low overlap with SCHD, and adding DGRO is exactly what can perfect a dividend portfolio, not complicate it. This is Dollar X Dollar, a channel dedicated to deep, data-backed ETF research for long-term investors focused on building financial independence. In this video, I will show you why DGRO fits so well next to SCHD, not instead of it. SCHD already does a great job anchoring dividend income. DGRO strengthens the portfolio by adding dividend growth and diversification while staying within the same disciplined dividend strategy. We will look at dividend growth, yield, overlap, and sector exposure, and then bring it all together to show why combining SCHD and DGRO creates a more complete and resilient dividend portfolio. This video is for educational purposes only and does not constitute financial advice. Without further ado, let's get started. DGRO is the iShares Core Dividend Growth ETF from BlackRock. It charges an expense ratio of 0.08%, which is very low for a dividend ETF, especially if you plan to hold it long-term. The fund is also very large, with about $37 billion in assets under management, so liquidity and scale are not an issue. DGRO has been around since June 2014, which means it is well established for more than 10 years, and has already been tested through multiple market cycles. Today, DGRO holds nearly 400 companies, which gives it much broader diversification than many traditional dividend ETFs. Looking at the portfolio, the top 5 holdings are Microsoft, Apple, JPMorgan Chase, Johnson & Johnson, and ExxonMobil. These are not yield traps. They are large, profitable companies that can afford to keep growing dividends. At the sector level, DGRO is also well diversified. The top 3 sectors are financials at about 21%, healthcare at about 17%, and information technology at about 16%. Now here is the part that really explains why DGRO behaves the way it does. DGRO tracks the Morningstar US Dividend Growth Index, and that index uses very clear selection rules. First, a company must grow its dividend for at least 5 consecutive years. No cuts and no pauses. Second, the dividend has to be sustainable. If a company is paying out more than 75% of its earnings, it gets excluded. And third, DGRO deliberately avoids the very highest yields. If a stock's dividend yield is in the top 10% of the market, it does not make the index. So DGRO is not chasing yield. It is filtering for companies that can keep paying and growing dividends over time. That index design is exactly why DGRO looks so different from high-yield dividend ETFs, and exactly why it pairs so well with SCHD. Now let's talk about income growth, because this is one of DGRO's biggest strengths, and it is the same strength that makes SCHD so popular. If you look at the dividend history on screen, one thing stands out immediately. Since 2015, DGRO has grown its dividend every single year. There were no cuts and no flat years, just steady upward progress. Back in 2015, DGRO paid about 65 cents per share. By 2025, that number had grown to about 145. That is more than double growth in dividend dollars over roughly a decade. What matters more is the pace of that growth. When you look at the long-term numbers, DGRO's dividend growth rate has typically fallen in the 5% to 8% range, depending on the period you measure. You do not need to read this year by year to understand the point. That kind of growth rate is exactly what long-term dividend investors look for, and it is the same income growth strength you see in SCHD. Even during tougher periods like 2018, 2020, and 2022, DGRO still delivered positive year-over-year dividend growth. The chart below makes it very clear. The trend is smooth, controlled, and consistent. So while SCHD anchors your income today, DGRO delivers reliable income growth in the background year after year. And that is a key reason why these two work so well together. Now let's talk about yield, because this is where DGRO is often misunderstood. If you look at the table on screen, DGRO's yield has been remarkably stable over time. For most years, the average yield has sat around 2% to 2.5%. More importantly, DGRO's yield has rarely fallen below 2%, even during weaker markets. That immediately puts it in a very different category from low-yield dividend growth ETFs. You can also see that DGRO does not rely on short-lived yield spikes. Yes, there were periods like 2020 when yields briefly moved higher due to price declines, but those spikes normalized quickly as prices recovered. That tells you the income here is coming from real dividends, not temporary distortions. Now look at the second chart showing yield on cost. This is what long-term investors actually experience. As dividends grow over time, the yield on your original investment keeps rising, even though the current market yield stays around the low 2% range. Over a full holding period, yield on cost moves steadily higher, reaching the mid-single digits for long-term holders. This is the same income dynamic that investors appreciate in SCHD. SCHD may start with a higher yield, but DGRO follows the same principle of letting dividend growth do the heavy lifting over time. So DGRO is not a high-yield ETF, but it is also not low income. It delivers a stable starting yield and then allows income to compound naturally year after year. And that balance is exactly why DGRO fits so well next to SCHD in a dividend portfolio. Now, this is where the SCHD plus DGRO pairing really starts to make sense. If you look at the overlap chart on screen, the first number that matters is this. The overlap between SCHD and DGRO is only about 17% by weight. That is very low, considering both are dividend ETFs. Out of SCHD's 102 holdings, only about 25 companies overlap with DGRO. And DGRO itself holds nearly 400 companies. So when you own both, you are not just doubling up on the same names. This matters a lot for income investors. If some of the core SCHD holdings go through a period of slower dividend growth, DGRO can help make up the difference, because it pulls income from a much broader group of dividend growers. That diversification is not theoretical. If you look at DGRO's top 10 holdings, you see companies like Microsoft, Apple, JP Morgan, Johnson & Johnson, ExxonMobil, and Broadcom, alongside other large, profitable businesses. These companies generate very strong and stable cash flows, which gives them a high ability to keep paying and growing dividends over time. And as a side benefit, names like Apple, Microsoft, and Broadcom can also contribute price momentum during strong market periods. That is not the primary goal of a dividend ETF, but it is a meaningful bonus when it shows up. Even when the same company appears in both ETFs, the weighting is usually very different. SCHD tends to concentrate more heavily in a smaller set of income names, while DGRO spreads exposure more evenly across the portfolio. That difference alone reduces concentration risk. Now look at the sector drift chart. SCHD is more overweight in sectors like energy, staples, and communications, which often deliver higher income but can see slower growth. DGRO carries more weight in financials, technology, and healthcare, which historically support stronger long-term dividend growth. So the takeaway is simple. SCHD anchors your income. DGRO broadens and stabilizes your dividend growth. When dividend growth slows in part of SCHD's portfolio, DGRO can help offset that with dividends coming from hundreds of other high-quality companies. Low overlap, more holdings, and strong underlying cash flow. That is why SCHD and DGRO work so well together. So when you put everything together, the logic becomes very clear. SCHD gives you a strong income anchor today. DGRO gives you reliable income growth and diversification over time. They share the same discipline around dividends, but they get there through different companies and different sector exposures. That is why the overlap stays low, and that is why the pair works. If this breakdown helped clarify how SCHD and DGRO fit together, consider liking the video and subscribing for more data-driven ETF analysis like this. Thanks for your time today, and I will see you in the next one.